What's going on, guys? Brian's here. Today is Sunday, August 28th, 2022. Now, we can rationalize what happens in the market as much as we'd like, but at the end of the day, random instances and random occurrences are very likely to happen. I want to break down the way I approached this week, starting from Monday, as well as what I was looking at on Friday, and hopefully the information that I share can help you guys make better trading decisions. Something that happened on Monday was this major gap down here, and I'm expecting us to have another gap down for Monday, which would be tomorrow as the market opens. I'm going to show you guys some of the trades that I have currently open. So this is the daily time frame for the SPY, but let's just jump down to a smaller time frame. What we have right here is the 15-minute time frame, and this is looking at mostly just this current week's price action, or the week that just finished. So this is Monday right here, and this would be Friday. The platform that I'm using is Thinkorswim. We can see that the market gapped down pretty large on Monday. Now, whenever this happens, the first thing I'm going to want to do is compare the gap down to the VIX. So as we take a look right here, this is a comparison side by side. On the left-hand side, we have the SPY, and on the right-hand side, we have the VIX. The VIX generally gaps up whenever the SPY gaps down. What was pretty significant in this case right here. So the levels that you guys see on the chart is actually generated from the quant trading app algorithm, and these are just quantifiable levels telling us statistically what the market has done in the past. So in this case right here, you guys can see that this level, this 412.66, the quant trading app algo was saying that in a sense this was what's referred to as the weekly support level, and it's a support level that statistically holds more time than it doesn't. And we can see that the market gapped down to it right here, and then we sold off to it towards the end of the day, and it actually held up the market for a few days until we actually ended up bouncing until we hit this 420 level. Now this purple level on the chart and this red level on the chart, I'll talk about those in a second, as well as this blue one. This blue one is referred to as max pain. If you've ever heard of that before, max pain is the strike price at expiration that has the least amount of intrinsic value for options. So in other words, it's the strike price where there's going to be the least amount of premium for option buyers, and it's really incentivized for option sellers to have the market pin around the strike price. Now, if you're an advocate of the max pain theory, you're aware of this. It tends to act as really good support and resistance throughout the week. So as we can see right here, earlier in the week, max pain was actually at 420. 420, the reason this is purple is because it's referred to as the absolute gamma strike. I will show that in a second, how we can see these levels, but it's just letting us know usually this is going to be a strike price that has a ton of liquidity, and it tends to act as a magnet for price. Down here, we have a high negative gamma strike, and this was the high negative gamma strike for the market for the entire week, and we will be also taking a look at what things looked like on Monday. Now we're looking at the quant trading app Discord here on Monday. So this was essentially my game plan on how I was looking at things. We can see right here, again, market gap down, sold off, and at that point 415 was the absolute gamma strike. So for that day, this updates every single day, by the way. So these levels that you see on the chart, again, from the quant trading app algorithm, and you guys can see that the blue dashed line, which is max pain, was at 420. So my logic early in the week was that the market was likely going to come down to this area, hold here, and towards the end of the week rally up to about 420. The thought process being, first and foremost, these are the tools that I like to look for. So I was mentioning we have, if the VIX breaks down below 23, SPY should have a nice shot at 420, and then we have the 420 call for Wednesday has been holding up pretty well. So again, this is on Monday for day trades, for scalps. You know, it wasn't a bad idea to be looking at the 420 calls a little bit early in the week. If you're looking to swing the trade, I was just mentioning that a 420 long call butterfly for Friday is a great low risk way to take the trade. And then the SPY has been consolidating at the absolute GEX level all day while the VIX spiked to the sell zone. So this is what I'm referring to. This, again, these levels are from the quant trading app algorithm, and they are generated every week right here, the weekly levels, and then we have daily levels that are also generated intraday that plots new levels fresh every pre-market. So what this is saying right now is, statistically in the past, this is where the VIX is likely to hit a high for the week, and it tends to struggle around this area, so we refer to it as the sell zone. I was letting the traders know that if the VIX breaks down below 23, then we have a great chance of being long. So as you guys can see, mention that here, if the VIX dips below 23 and starts selling off the IV, so the implied volatility for everyone that purchased the short-term inflated puts on this gap down today will be in trouble. What I meant by that was, as the markets gapped down right here, everyone buying these short-term inflated puts, because as the market gaps down and IV spikes up, the price or the premium that it costs to buy a put is increased significantly. There was a lot of people buying the 410 put, and that's what we can see right here. So this is a screenshot from that time frame. So if I click this right here, it'll just pull us straight to this channel, which archives the gamma exposure levels as well as the volume at the time when these options were being traded, as well as the gamma exposure. So we can see right here, this was saying that the SPY was at 415 at the time this screenshot was generated, and I'm just rounding it up obviously by a penny. And then we can see that the 410 strike was the strike price that had a lot of massive gamma right here, negative gamma in this case, and 420 had a lot of negative gamma also at this point because we had gapped down below 420. Now what was significant is we can see in the background here, right here, we had a lot of volume at this strike, so over 30,000 volume at this point in time, and that's everyone buying the 410 put for the Friday expiration. The problem being, if we jump back to this right here, the problem with this is if everyone is piling into this put, this strike price, if implied volatility starts coming down, this strike price is actually going to end up acting as a massive support or a massive repellent, and price is going to look to bounce into the other direction, which would be 420. And you guys can see that right now at this point, as I mentioned, 420 was the max pain earlier on in the week. Another key takeaway when you're looking at gamma exposures, whenever you see a strike price like this, so the 415 strike had positive gamma and it was surrounded by a ton of negative gamma. This is something I've talked about in the past and I've shown it in previous videos. This level is likely to act as a very strong support, or it's going to act as a very, very key significant level. And that would explain why price was consolidating around 415 early in the week before we started selling off going into power hour right here. The 415 level, which would be this level right here, it was acting as a massive consolidation zone because that's what's likely to happen around the absolute gamma strikes. These are strike prices that have a lot of liquidity and they end up becoming very important. As you guys can see on Tuesday, the market rejected at the 415 level, and on Wednesday we also rejected at the 415 level. Now, as we jump back to the Discord, let's actually see what else I was saying here. So I've shown this previously. Whenever there's one strike that has positive GEX and a bunch of negative GEX, it's very likely to hold for a while, especially as price takes time to work through it, blah, blah, blah. Same thing works in reverse if it's blah, 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 blah. So all of us saying here, again, 420 is the target. So if the VIX, just again, reiterating what I mentioned before, but saying if the VIX remains above the 23 level or continues to rise, the chance of a market bounce happening will be very hard this week. We come back to the chart and you guys can see what ended up happening. So the VIX actually ended up rallying a little bit on Monday. So the SPY continued to sell off here. The next day, the market was very choppy. I was not expecting a direction on this day. And you guys can see that there was no reason. The inclination for me to get long the market was only if the VIX drops down below 23, because again, if historically and statistically this is the level that's supposed to act as resistance for the week for the VIX, it means I want to be long the SPY, but only if the VIX is showing weakness. This right here is referred to as front side strength. So as there's momentum to the upside, you don't want to short, momentum, in other words. So in this case, since the VIX is generally inverse of the price action on the S&P 500, we want to see the VIX selling off before we decide to go long the SPY. So later in the week, I ended up going long right here because that was the inclination. The VIX broke down below 23. I generally like to open up my swing trades during power hour, as a lot of other traders do. And I'm predominantly a swing trader these days. So I'm looking for price action towards the end of the day. And as we can see that the VIX broke down. So this is our backside weakness. We had a lot of front side strength. We had a lower high right here. We had another attempt at a lower high, and at the same time the SPY was holding what's referred to as the QTA buy zone or the QTA weekly support level. So this is my inclination to go long. Before we review this trade, I just want to take a second to kind of review what I just mentioned. First thing that I looked at is the SPY gapped down, right? At the same time, how much did the VIX gap up is important. Next, I'm looking already, because the market gapped down and we're hitting a level that statistically we're very likely to bounce. I want to look for reasons to be long, but at the same time, I don't want to be earlier. You don't need to be the first person to be long, or you don't need to be the first person to short. A lot of traders make that decision not understanding the patience that comes behind, knowing that it's going to take a couple days sometimes for these trades to develop. As we actually jump back to the Discord here, I want to also highlight something to you guys. So if we come right here, this is something else that I was mentioning. So there's a lot of technical reasons to believe the market will bounce. This is actually how my trade structure was at the time. So I was already up about, I believe I was up around here. So about $1,200 or so in some of the positions. So I was just sharing some of the open positions I had in the SPX. And then at the same time showing that I had opened up a long call butterfly in the SPX targeting the 4,200 strike. This was the combination of, I believe, a double diagonal, a couple butterflies, and a couple other spreads, all, and some calendars for the 4,100 level that I was opening up a couple weeks ago. I've done a video on some of the trades in which I was already in. So that's what that graph was just showing here, that risk profile. But I was highlighting this. This is the volume profile on the SPY, and it's set to the weekly time frame here. That's how it's aggregating this data. And I was showing that there was a key point of control here, and there was a lot of high volume nodes in confluence with the fact that this was in the quant trading at buy zone. So if we jump back to the chart and let's actually scroll over to here, and let's turn on all of our studies on this one here. Let's turn these back on. So we can see again, this is what we were looking at. It's the same chart. And then let's actually just jump to the daily and let's go to our volume profile. So here we have the volume profile. This would be the gap down here on Monday. And we can see that there's a ton of volume in this area, right? Let's actually scroll over now and look at things from the weekly time frame. So here we have gap down on Monday. Market gaps down into this high volume nodes right here. We had this point of control from this massive consolidation that occurred for this entire week right here. Next key levels we have is all the way down here, which is right around the 396 level. But we know that the 400 level is likely to be very important for this week also. So as we're coming into this week, the market is gapping down into an expected high demand zone. This is something I've done in a video. I believe it was called how to trade during a choppy market. And I said, think about it this way. If you are looking to be short and the market just dropped all the way down from here, I think it made almost a 4.5% move. So let's actually see. So from the top, from here all the way down to here, this was a, for about a 4.5% drop, and it's into a demand zone. Things are more likely to either consolidate or go up. Right? It's less likely that we're going to just go right down the next day. So if the market makes this big move, it's more than a one standard deviation move. We can actually check right here. Let's see. So this would be the SPY from since 2007. All of the daily candles, and we can see right here, this would be the crash back in 2008 and 2009 right here, the financial crash. And then we can see this was the COVID crash right here of 2020. But aside from that, there's a little bit of a yellowish beige level right here in the background that I'll show you guys a little cleaner on another page. But you guys can see this is saying right here, this is a one standard deviation for the SPY, aggregating 3,940 candles, which is years worth of information. A 1.3% is a one standard deviation. If we come right here, this is for the last 365 trading days. We can see it's a little bit larger, but generally this is standard information for any type of quant, any type of hedge fund, any type of statistical database. Everyone in a sense knows this. If you don't know this, I'm happy to be the first one educating you on this, but a one standard deviation for the SPY has been for the longest while a 1.3 standard deviation move. That just means if the market is down about 1.3%, that's generally going to be where it's going to start meeting some sort of support. If it breaks out of that, it's in uncharted territory as it's going closer to a 2 standard deviation move and even close to a 3 standard deviation move. But for the most part, majority of price action tends to take place in a minus. So from here, this is our zero line, a minus 1.33% standard deviation, and then to the upside the same thing, a plus 1.33%. Again, this is for this last 365 days. If we look at a larger sample set, it's about 1.3. It's pretty close. It's a little bit, market's been a little bit more volatile as we know this year, so that's why it's a little bit higher, but we can just say 1.3. So that's something you're going to want to know. If we take a look at the chart, and let's actually jump back to the smaller time frame, and we take a look from last Friday's close, which would be right here, and we dropped down, the market actually gaps down, and it already did what it usually does in one day. So 1.2%, all the way down from here to here now was a 1.2% or so. So we zoom in for a second, knowing that the market already gaps down and it did what it normally does in an entire day, that is always going to make me first start thinking from pre-market, is this the type of day that I want to be long, or is this the type of day I want to continue shorting? Whenever the market makes a big move like this, I already consider myself not looking for the short, because I tell myself the people that caught the short from here are already rewarded. The risk reward becomes a little bit screwed. I'd rather wait for another setup before I look to go short, which is what we're getting to. As you guys can see on Friday, here was an amazing time to be short. But first, understanding that the way things were expected to play out did play out early in this week, because as you guys can see, the buy zone held for a couple days. While this is happening, implied volatility is coming down. So that was the game plan from Monday. Let implied volatility decrease, because all the people that are in these 420 puts, the delta is decreasing on these 410 puts. As the 410 puts delta starts decreasing, market makers are likely to start buying back their shares that they shorted as a hedge when they sold the 410 put. So in other words, the 410 put was purchased by a bunch of retail traders. It could be investors. It could be people looking to hedge their portfolios, because this is a scary gap down with continued selling. We had sold off way past a 1 standard deviation move, and that's going to trigger certain funds, certain institutions are going to have to start hedging. And then you have retail traders that are just buying a bunch of this put because they're seeing a ton of open interest at the 410 strike, not understanding the context of things. Again, if we zoom out, we take a look, there's expected to be a ton of demand in this level as we looked at the volume profile. So all we have to do is just wait and let people burn themselves out. I forget the trader that I learned this from. It might have been Brian Shannon, who's known as the father of the anchored VWAP online. I think he's the one that I remember hearing say this, but it was something along the lines of let other traders pay for the information that you're looking to find. So in other words, don't be the trader that is paying money to the market to figure out information. There's other traders such as myself that's waiting on the sidelines during a day like this because I know the information I need is going to be presented towards the end of the day going into the next day. And this is something that I've mentioned before. If we think of this as a boxing match, who's getting more exhausted down here? It's more than likely going to be the bears that had to be net short from all the way up here all the way down here. They've been shorting this whole time, and then we get down to this point where this is the case where bulls have been recharged because bulls have been long from here. They ended up winning, so now price comes back to a territory in which bulls are well rested. They're looking to defend their averages, their positions, and they're willing to take prices up to the next presumable target, which would have been 420 right here. 420 was the strike price that had the highest positive gamma, I believe, earlier in the week. We can review that as we jump over here and actually just check. If we check the archive and we scroll down, let's see. So this would now be on the 23rd. Let's see. We have 415, and then 415 we have 430 was a lot of gamma, but then we can see 420. We can see the blue right here is the volume. So there was a lot of people buying the 420 calls earlier in the week because that was the expected targets. I don't remember what the absolute gamma was at that point, but I believe it was the second or third highest absolute gamma strike. So that's just going to show where there's going to be a lot of liquidity, and we knew that level was at 420. On top of that, there was a lot of traders buying the 420 calls. So moving right along, let's actually jump over to here and let's see, and let's just flash forward a little bit as I'm scrolling through Discord here. So 410 had a lot of GEX as we were pointing out. We can see that this was the buy zone also on the SPX. So same thing, we want to be looking for reasons to buy, but we want to take our time, be patient with it. This is just something I was mentioning at this point because if the market was to gap up the following day, if it gapped up over the 2-day anchored VWAP, it was likely to be a bullish day the following day. So all this whole time I was just looking for reasons to be long. Here's what the absolute gamma looked like at this point. So the 410 and the 415 were equal at this point in time. So it was a tug of war between the two strikes. So it's just saying which price was likely to win at this point, but at the same time being patient. Here was again the same risk profile as I started taking profits, but we can see I was targeting 420 towards the end of the week, but at the same time it was currently up about $1,200, and then we can see that my theta was positive, so I was able to remain in this while I was waiting to figure out which way the market was going to go. As we continue scrolling along right here, we have same thing. Here is the 410, a lot of negative gamma at this strike as it's letting us know. And then at the same time, the 400 level is a very significant level. And this was as early as August 24th, which was still Wednesday. And this page was generated pre-market. So about 16 minutes before the market opened, just sharing the same information right here. If the 410 level was not going to hold, it was likely going to be a straight flush down to 405. And then from 405, we have very high reasons to believe the market is going to 400, which is where I think it's likely going for this week. Continuing right along, right here goes Wednesday. Market's still holding within the buy zone, just simply sitting back and waiting for price action to reveal when's the best place to get long, or better yet, when's the best time to get long. And then here we have it. So on the 24th right here, it looks like the VIX is finally breaking down. So now it's during power hour, and it looks like it's going to be closing below 23. That's when I really got interested. And then we have it right here. I'm going to swing the 417 call because the VIX is finally pulling back. And then I chose the September monthly instead of going with the same week expirations. So as we jump to the chart, that was right here, as I mentioned early in this video, during power hour, once we broke back over, because now at this point, this is one attempt to cross over 415, a second attempt to cross over 415. We can see that the gamma for the 410 strike was starting to shrink, and that's one way of seeing that these puts are starting to being closed out as the delta is decreasing on them. So this is what's referred to as a Vanna rally combined with charm, because charm decays option deltas as time is passing by. So we have Vanna and we have charm, and then we have a magnet all the way up here at 420. So just waiting these couple days here, this ended up being a nice trade. I ended up closing the trade once we got up to about here the following day. The reason why I ended up holding it right there is because if we jump to the next day, I mentioned this right here to another trader that took the trade with me. It was right here. It's just understanding the gamma. So we can see right now the 410, The 410 was nowhere near as massive as it was early in the week, as it lost some of its strength. 420 ended up taking over, but at the same time, we can see that there wasn't a lot of gamma between 416 and 417. So I was expecting us to go to about 418. So I ended up taking my profit target a little bit right before I took this picture. But once we were over 415 again, it was almost an easy breezy trade all the way up to the 417 and a quarter. Closed the trade out there, and that was the naked option on the 417 calls. The reason I went for 417 as opposed to 420 is because you guys can see as the week progressed, the max pain strike was no longer at 420. It actually dropped. The absolute VIX was at 420, so I knew we were likely to make some sort of attempt for 420, but I wanted to go with 417 because I wanted the strike to go in the money when I was swinging it, and I also gave it plenty of time by going with the monthly expiration, so I didn't have to worry with too much time decay. On top of that, I was in a butterfly spread, so if you guys have never seen a butterfly spread, I highly encourage you guys to swing these types of trades as they're really good from a risk reward standpoint. So in other words, let's just say we think the market is going to bounce about 100 points or 75 points this week at one point between Monday and Wednesday or so. A spread like this is only $1.80 right now, and we can see if the market was to rally to 41.50, which would be maybe your target, this trade is going to be up about 100% right here. So from here to here, and at the same time, if you're wrong and the market pulls down, you're going to be up down about 30% or so. So it's just great risk reward, and at the same time, the theta doesn't work the same way when you trade these types of spreads versus a naked option, because if the market goes nowhere for a couple days, you're actually not going to be losing money because of time decay, or at least for a few hours. So that's something that I like to swing trade, and it's a great low risk way to stay in a trade, because it means if you are right and at the expiration date, which would be Friday, you can end up getting a massive return. As you guys can see, this is the max profit if the SPX actually ends up pinning at your strike. So it's something that I like to do. So I was in some of those for the SPY, close these out on this push up here, and then proceeded to open up some new positions. So the positions I opened up on Friday, I believe I posted them in here. Let's just find. So the positions I open up for Friday would be right here. We have the SPY 7/8 till expiration long put butterfly. So same thing. So it's just the same thing which I just mentioned. But sometimes if I want a wider range, I will go with the SPY because I can get a wider range, which is a higher probability of profit, and it's not going to cost as much, and I can scale into these. So I can get 3 or 4 of these, and it's not going to cost that much for myself right now because I can scale into these, and it's not going to cost as much as the SPX positions, because for the same cost in the SPX, you'd have to have a narrow butterfly. So something that looks more like this, and then you have a really, really low chance of profit because it's such a narrow window. So I just wanted a really nice range, and I alternate between the SPY and the SPX depending on the spread, in addition to a few other trades. So this is a great one to be in. This is what's called a broken wing butterfly. There's no risk to the downside, so it doesn't matter how low the market goes, and this is a spread that expires tomorrow. So grabbed a few of those also in the SPY. This one was for the SPX, and a myriad of other trades, all targeting the downside. Just because if we wrap up this video, if we take a look at the gamma exposure, this right now is the gamma exposure for the month of September and the rest of August, and we can see the 400 level is still very dominant. We scroll down right here, we can see with the absolute VIX perspective how dominant it actually is, and then we have the 410 level. So if I look at this, I would say anything over 410 right now, if we get up to 415 in this area here, is a great place. It's likely to be a lot of supply that would form, and as we get around the 400 level, I would expect us to kind of chop around this area for a couple of days or so. But if implied volatility keeps increasing, now that the market is in a net negative gamma state, that means there's going to be a lot more increased volatility, as the dealers, aka the market makers, will be selling as the market is continuing to go down until it gets to the point where implied volatility gets to ridiculous levels. But I'm going to conclude this video here, as in a few days I'm going to do my full gamma analysis report for what I think is likely to happen for the next month as well as the next quarter and so forth. So I'll save that for the next video. I just want to give you guys a little bit of a preview. And then what I'm expecting tomorrow is us obviously to come down to this level. If not, then I would be looking to catch the bounce back up to 410. But at the end of the day, the way in which my trades are structured is I don't have that much risk in either direction right now, but I am slightly net short, and that just comes from a little bit of experience as well as looking at the gamma exposure and knowing generally whenever the market has some sort of massive sell-off like this, it's not something that ends within one day. I mean, we closed at the lows on Friday, volume was increased. That's a really, really bad sign for the market right now. If anything, I'm concerned with, I didn't give myself enough room to the downside. I should have been in some 390 puts and even some 380 puts for a couple months out, but I kind of missed the train on that. I ended up day trading. I got so caught up with all the price action that happened intraday that I ended up opening up the spreads towards the end of the day, and then I didn't want to get the naked options towards the end of the day. That's on me. But anyway, hope you guys enjoyed this video. Leave a comment down below, like it, and share it if you learned something, and I look forward to hearing from you guys in the next one. Take care.